Welcome, everybody. Thank you all for being here and joining us for today's workshop on Social Security. My name is Paige. I am the Charitable Giving Manager here at Vivalon, and I want to just introduce some of our team here in the back. We have Amy McConnell, sorry, who's our Chief Development Officer, and Yvonne Roberts, who's our Senior Donor Relations Officer. And we have a special guest with us here today, which is Sherry from Valley Memorial Park Cemetery and Funeral Home, and one of our sponsors here today. Our other sponsor is Carrie Spence, Estate Planning. So we like to thank them for sponsoring this series that we do every month. So we really appreciate your support. Thank you. Is anyone here for the first time? Oh, welcome. Thank you for joining us. On Zoom, welcome as well. And if you are here for the first time, I'd love to invite you to come back and get a tour and see all that we're doing. I think we'll put out some of our newsletters so you can see all the classes. We have about 60 or more different classes every month. So we have something for everybody. Some of our classes are also hybrid on Zoom. Some are just online. We also have our wonderful cafe. I had lunch there today. So you can come and you do not have to be a member to come to any of our classes or our cafeteria. So we welcome you back anytime to check us out. So one of the things that we all know is very important is that we need to have a will and trust, right? And that's why we started this estate planning workshop series to help people with all aspects of that and everything that might be involved with estate planning and, helping us be more financially secure as we are retired. So one of the things that Vivalon did, I'm going to share my screen here, is we partnered with a company called Free Will. So that people could, what we learned is, I guess, nationwide, there's like over 70% of people do not have a will and trust of adults. So we partnered with Free Will, who is a very well-known company. They're kind of at the top of their game, which is really great. But they can, you can go online if you don't have your will and trust yet. You can make it for free. They don't even ask for a credit card. If you already have a will and trust, it's a great way to go through because they ask you all the questions. If you need to update your will and trust, that you can get that information put together for your attorney if you have an attorney that you work with. It's also a great way to leave a legacy to organizations that you care about. There's an opportunity to do that when you fill out your stuff. It takes about probably 20 to 30 minutes to fill it out, and they walk you through it step by step. It's like TurboTax. So if you haven't made your will and trust yet, let me just show you on our website where to go to find that. So if you go under ways to support and then go to our planned giving, and if you click on that, you can go, it's right on the starting page. You start your will, and then this pops up and start my free will. And just, it'll walk you through the steps from there. So pretty simple. So, but with no further ado, because I know Social Security is a hot topic on everybody's mind, I want to introduce our guest speakers today. We're delighted to have Meghan Hyland and Matt Taddei, who are here to discuss to discuss Social Security requirement benefits and how you can optimize your Social Security decisions in the context of your overall financial plan. Meghan joined WestHill in 2015, 2 weeks after graduating from Dominican University, right here in San Rafael. So she's a hometown girl. Meghan is the Director of Financial Planning at WestHill and provides comprehensive financial planning for the firm's clients. She is a certified financial planner. In 2023, Meghan earned her MBA from Pepperdine University. Congratulations on that. And Matt Taddei is the co-founder of WestHill 36 years ago, and he serves as the firm's president and CEO. He's also a certified financial planner. In 2023, Matt received his PhD in financial and retirement planning from American College. On May 15th, Matt will be leading a thinking and writing workshop right here at Vivalon on the topic of thriving in retirement. So if you haven't signed up for that event, that will be a great one. So with no further ado, I'm going to start their slideshow here and get out of their way and let them educate us. Thank you. Can we give them a big hand, please? For the folks on Zoom, somebody in the audience asked if they were going to cover the current world of what's happening with Social Security, the repercussions.
So the good news is we are. The maybe less the good news is it's the very last segment that we're doing. So, but looking forward to that conversation. We're going to talk about both how Social Security is in the news right now and also the future financial viability of Social Security. So thank you for that question. So thank you all for joining us. And of course, Adrian, Paige, Amy, Yvonne, thank you all. We love working with Vivalon. We love being at Vivalon. So our objective today is for you to have a better understanding on how Social Security benefits are calculated so that you can make optimum decisions regarding your own benefits. Secondly, our second objective is that you make your retirement decisions with Social Security in the overall context of your financial plan. For many of us, for many of you, Social Security benefits will be a critical part of your retirement plan. So the decisions you make, and hopefully will help you with some strategies to optimize your decision making. The decisions you make could have a significant impact on your financial security. Here is our agenda today. And most of the bullet points you see here relate to those two objectives I mentioned. To your question earlier, thank you for that. The last item, we're going to talk about Social Security now in the news and also the future viability of Social Security going forward. At the end, we will leave plenty of time for questions, and then periodically throughout our discussion today, we'll open it up for questions as well. So let's talk about first the impact of Social Security. First, on a general or global level, Social Security has an enormous impact on our society and our economy. And by the way, this year, Social Security is turning 90 years old. So if you think about it, you might want to mark your calendar. August is the time you can send a birthday card to Social Security. Keep that in mind. The point here we want to make is that Social Security today looks much different than it did when it was started 90 years ago. It is much more expansive. It is much more comprehensive. So a few points to underscore that. First of all, think about this. 97% of Americans are either receiving Social Security benefits now or will receive Social Security benefits in the future. Second, 170 million Americans, about half of the population, are currently paying payroll taxes into the Social Security system. 170 million people. Third, 67 million Americans are receiving Social Security benefits in some form. So that could be disability, it could be survivorship. For most, as you see in the pie chart here, 84% of Social Security benefits are paid out as retirement benefits. And that's the focus of our conversation today. Last point on this slide is keep some of these numbers in mind for that last segment in our agenda. Is while they may seem like trivia, the sheer enormity of these numbers has a lot of power. When I say 97% of Americans currently get or will get Social Security benefits, most of those people are voters. Keep that in mind when we talk about the future viability of Social Security. What about the impact of Social Security individually on you and on me? So once upon a time, most employees were covered under what's known as defined benefit pension plans. Have some of you heard of defined benefit pension plans? These were wonderful plans. You would retire. The first month you retire, you got a monthly check, and you got monthly income until the day you died. These were terrific. Unfortunately, they've sort of gone the way of the dinosaur. Less than 1 in 5 Americans now is covered by defined benefit pension plan. And most of those are employees in the public sector, teachers, firefighters, police officers. So for most of us, Social Security is our only lifetime guaranteed pension. That's the bad news. The good news is Social Security really has robust, valuable benefits. You see on the slide there, think about these 3 components. Guaranteed lifetime income in retirement, not just guaranteed by the US government, 1. 2, that guaranteed lifetime income, it goes up every year with inflation. And 3, Social Security retirement benefits have, if you're married, a survivor benefit. So think about averages here. The average retiree receiving Social Security benefits gets right around $2,000 a month. The maximum retirement benefit from Social Security for those taking Social Security benefits at full retirement age, and Meghan will define what full retirement age is in just a few minutes, is around $4,000 a month. So what this means, and again, bringing this back to the impact of Social Security on each of us, is that many of us, most of us, during our retirement, will collect hundreds of thousands of dollars, maybe even millions of dollars from Social Security. And as you'll see in some of the work we do, some of the presentation and examples, making optimum decisions can literally mean an extra $200,000 or $300,000 to you. That's the importance of this. Meghan.
All right. All right. Thank you, Matt. And thank you all for having us today. So Matt walked us through a little introduction, but I'm going to get into the meat of the situation. When should we take Social Security? I'm sure lots of you have questions, different claiming strategies. So let's get into it. But as we all know, this is a complicated topic. And so I thought it'd be helpful to start with what I call the basics. So let's just start with some Social Security terms. Matt alluded to already full retirement age, or FRA. So this is the predetermined age at which a worker will receive their full Social Security benefit amount based on what year the worker was born. So when you were born determines what Social Security is predefining for you as your full retirement age. So it is not the age that you actually retire. Common misconception. Then there's the primary insurance amount. This is the monthly benefit that a worker will receive at their Social Security full retirement age, which is calculated based on their average index monthly earnings, or AIM. All right. So the primary insurance amount is the amount that you would get at full retirement age. Then we have 3 different categories of people. We have spousal benefits, survivor benefits, and ex-spouse benefits. Okay, so we'll see if any of you fall into these 3 categories. A spousal benefit is 50% of your spouse's full retirement age benefit. In order to qualify for receiving a spousal benefit, you must be age 62 and your spouse must be claiming their own benefit. So you didn't used to be that way. You used to be able to claim your spouse's benefit even if they weren't claiming yet. Now they have to be claiming. Okay. Now when would this come up? Well, let's say I was a homemaker and I didn't work a 9-to-5 job and I didn't contribute a lot to the Social Security system. So my Social Security benefit would be much lower than like my spouse's. So I would take my spousal benefit based on his or her benefit. Okay. The survivor benefit is 100% of your spouse's full retirement age benefit or their delayed amount. So I'll get back to this in a moment, but if you delay your Social Security benefits, they increase. Okay. So if you're a survivor, that you would get 100% of the delayed benefit or the full retirement age benefit, which is a great thing. To qualify, you must be age 60 and currently be married or have been married for more than 10 years. So if my spouse dies and his benefit is bigger than mine, I get his. Now, another misconception, I do not get both. I don't get mine and his. I just get the greater of the two. That's important to remember. And lastly is the ex-spouse benefit. So this is 50% of your ex-spouse's Social Security full retirement age benefit. In order to qualify for this benefit, you must have been married for 10 or more years. The filer, which would be you, must be at least age 62, and the filer must be currently unmarried. So if I was married more than 10 years, divorced, even if I had a marriage, let's say for another 2 years to somebody else in between, but now I'm not married again, I can claim benefits on my spouse that I was married for 10 plus years. Another question I get all the time is my spouse gonna know, my ex-spouse, that I'm collecting on his benefit? No, he will not be notified. They won't know. So you don't have to worry about that. And it does not affect the other person's benefit. Okay, so just some terms to know. I might use these in the future. Primarily, you want to know full retirement age. That's the most important. All right, so let's move forward and talk about the timing of taking your benefit and how that impacts the amount of the benefit. So let's stay up at the top of the screen. There's a timeline there. And there's really 3 ages that I want to draw your attention to. The first is age 62, which is on the far left. 62 is the earliest age that you can take Social Security retirement benefits. Okay. Then there's your full retirement age. Now, your full retirement age, again, that predetermined age by Social Security depends on the year you were born. So go ahead and look down at the chart at the bottom. Find your birth year, and then that's the age that is your full benefit amount. At that age, you will get what Social Security deems as your full benefit. Okay, for most of us, it's age 67, and that would be born in 1960 and above. Okay, so that's full retirement age. For the rest of this presentation, I'm going to refer to age 67 as the full retirement age, but it could be different if you were born earlier. Okay, and then the last date is the delayed age at age 70. That is the last point where you can claim Social Security benefits. People ask me, I want to wait till 71 or 72 and let it keep growing. Nope, Social Security will start to send you that check at 70. That's it. That's the last time you can do it. So why would you take it early? Why would you delay it? So from age 62 to 66, you can see the effect of the benefit in dollars and percentage. If at age 67, your full benefit is $3,000 a month, that's 100% of your benefit. Then if you took it at age 63, you'd only get $2,250 a month, which is about 75% of your benefit. On the other hand, if you delayed it till age 70, you get $3,720 a month, which is 124% of your benefit. So you take it early, it's reduced. You wait, you get an 8% increase per year. This is a really important concept to know going forward. That question of, do I take it early or do I delay? The final point I'll make here, and then I'll get to your question, is we do tell people that this is an irrevocable decision. So you want to be sure. However, that's not fully true. I think you have about 12 months to go back on your decision, call up Social Security and change it. However, please keep in mind, if you do that, you would have to return the benefits that you've already received from Social Security back to them. So I probably don't recommend that. Go ahead. Do you have a question? Hmm. Yeah, they would just send it if she's not. Oh, yes, sorry, I'll repeat the question for those on Zoom. So if you wait till after 70 and don't do anything, don't notify Social Security, will you get the check? Yes, my understanding is that the check will just come. Now, Social Security, as we know, is not perfect. And so if you're not receiving your check or something's wrong, you definitely want to give them a call or make an appointment. But my understanding is you don't have to do anything. Correct. If the response was if they're still working at 73, they should be getting their Social Security, and that is correct. 70 is the latest date. We have
there where it says I was born in 1959.
Mhm.
So my full retirement age is at 66 plus 10 months.
66 and 10 months.
Okay. Thank you.
You're welcome. We had another question?
Yeah. Senior moment. Dang.
That's okay. We'll be here.
Hi, my name is Linda. I'm almost 60,
Mhm.
getting there, and I've been on permanent disability for a number of years. My question to you is, does my disability benefits and just roll into Social Security when it gets to that point? It's the same amount and it doesn't change, or eventually it will go up?
Great question. My knowledge or expertise or focus is more on the retirement benefits of Social Security, but my understanding is that if you continue to qualify for disability benefits, meaning you remain disabled by Social Security standards, all the way up until your full retirement age, so whatever that age is here on the chart, then you would switch over to your retirement benefits from Social Security at your full retirement age. Okay. Excellent. All right, great. Well, let's move forward. So let me just say, by day, I'm usually a financial planner, and I love what I do. I love helping families answer questions, make decisions, and Social Security is a huge part of that. So when clients usually come to me, there's usually 3 questions regarding Social Security that they ask. When should I take it? Why the heck would I delay it? And how much will I get? Very common 3 questions. The really hard part for me as a financial planner is that these are questions in isolation. And what that means is really hard for me to answer when should I take it if all I know is your Social Security. I need to know your cash flow, your other assets, your retirement plans, your estate plans, your tax plans. You might think, why does she need to know all of those things? Because, and I'll show you throughout this presentation, making a decision in isolation is, I caution you on that, because all of these things are very, very connected, right? Your education planning for your kids or grandkids, your overall financial health, your risk, insurance management, your investment portfolio, what's your risk tolerance, what other assets do you have, when you retire, your tax situation, and your overall estate plan. All of these things are at play at all times. So you really need to make Social Security decisions in the context of your overall financial plan, which is what I will stress here today. And again, I'll show you some examples of how it can really make a big difference. Okay. So financial planning is, again, pulling all of these different things together to make decisions, not just on Social Security, but on all sorts of financial questions that you may have. Financial planning really allows you to zoom out, not focus on one question, but look at your whole financial picture and your future. It helps you get honest about where you are. Most of the time, money is a hard topic for most people. Most of the time, people come in and they have some sort of feelings, shame, guilt, excitement, whatever about what they've done in the past. Maybe we didn't save enough, whatever. Let's take a real assessment of where you are today, where you want to be in the future. Let's create a path forward and give you support along the way, which is probably one of the most important things, to have a sounding board, somebody there to bounce ideas off of and to help guide you throughout time. So at WestHill, this is our financial planning process, and I won't spend too much time here, but I do think it's important. One of the things I want you to take away today is, do you have a financial planner, or do you know someone who could help you with a financial plan? Because I think it's very important. So we meet with clients, we do a discovery meeting. That's where clients ask us those questions, those big concerns, the things that keep you up at night. We get all that down on paper. Then we go through all your documents and find out who you are, what you have, debts, liabilities, taxes, all of it. And then we look at a couple different things. One is what we call life planning. We actually have a whole meeting dedicated to non-financial matters. We're having conversations about what do you want to do with your life? What are you going to do when you retire? What's going to fill your time? What fills your cup? Spouses having these conversations, sometimes for the first time. So we have a whole meeting dedicated to that. We do scenario analysis. What if I took Social Security early versus what if I delayed? We look at the different options, and you can see right there in black and white how that affects your financial plan. And then, of course, we deliver all of our recommendations and provide a year of support after we deliver the financial plan, just because I want you to be financially successful and to implement the things that we recommend and not just put it on the shelf and call it a day and a nice activity. So this is our planning process. But again, anywhere you go, I think that this is really important for you. So let's get back to the reason that you came here today. And let's go over some examples of when you should claim Social Security benefits. So my first example here, you'll see the boxes at the bottom of the screen. I have two spouses. They're a similar age or the same age, and they have a similar full retirement benefit from Social Security. Okay, age 62, and each of their benefits is $3,000 a month. So what the graph is showing you here is you have a red line, a yellow line, and a green line. The red line is if you took Social Security early, let's say at age 62, what is your cumulative benefit? Think of all the money you're getting from Social Security accumulating over the years. What is that amount? Okay, and obviously if you take the benefit at 62 for the first couple years, you're accumulating way more than you would if you delayed, because you wouldn't have taken the benefit yet. Okay, if you take it at full retirement age, then you start accumulating benefits, and then delayed, you start accumulating benefits. What we're looking for is what is the inflection point, or where the lines cross, to ultimately tell us which strategy wins. Basically, which strategy gives you the most money from Social Security over your lifetime. The inflection point you'll see in the blue bubble at the top there is at age 86, or excuse me, 86. When both spouses are 86, then you can see the green line takes off a little bit. It means you were best off if you delayed Social Security benefits till age 70 if you live past age 86. Now, the only variables we're using here are age and the benefit amount. So we'll go over some other variables later, because there's lots of other ones that are very important. But in this example, if this sounds like you and your spouse, good chances are you should delay your benefits, okay? Another way to look at the same information that we just looked at is in a table instead of a graph. Okay? You'll see like the red shaded box at the top there, the pretty large one, from 2024 to 2043, those are all the years where you would be better off taking your benefits if you took them at age 62. So you can see all the way from age 62 to age 81. You're better off if you take them at age 62. If you live to age 82 to 85, you were better off if you took it at full retirement age. And if you live beyond age 86, you were better if you delayed till 70. Again, better meaning that you're getting the most amount of money from Social Security. Okay. So we can look at this in different ways, but I think it's really important what we're saying over in the blue box. If you live till age 90 and you delayed your benefits to age 70, you would receive more than $250,000 from Social Security over your lifetime than if you took it early. That's a big number. That's a big amount of money. So this is a big, important decision to make. Okay, now I want to address something in the room, maybe some feelings that are coming up for you, okay? When I say you should delay your benefits till age 70, who feels a little nervous? Like, I don't want to do that. I don't want to do that. I see some hands, probably some more that aren't raising their hands. Very common feeling or reaction that I get from clients all the time. And I want to just take a moment to address it because I think it's really important. So there are three primary reasons that this feeling kind of comes up in us. Like, I don't want to delay it. I want to take it now. Okay. One of them is what Matt's going to talk about later, which is the future or the current situation of Social Security. Is Social Security going to be here for us? I better take it now to make sure I get it. Matt will talk about that. There's two other things here, and we really need to be aware of the biases that we have. We all have them. It's a human trait, but it blocks our good decision making. One of them is what we call the present bias. I better take Social Security now before it's gone. The thinking there of I'd rather have something today that I know than wait a few years for something I don't know, that's uncertain. That's a present bias, even if it makes more sense to wait. Okay, so just be aware, maybe that's coming up for you. The other really big one is life expectancy. I won't live that long. Who thought that when I said age 90, 95, anyone say, I'm not going to live that long? Yeah, I get that all the time. I'm not going to live that long. You might. We don't know. That is the best answer to that. We don't know. But maybe to shed some light on that is Matt. I'm going to turn it over to you for a moment.
So as Megan mentioned, financial planning, claiming Social Security retirement benefits is predicated on a number of assumptions. We're going to talk now about the life expectancy assumption we have. Life expectancy, the figure that you use, your own life expectancy assumption, is so important, not just with respect to claiming Social Security retirement benefits, but also in financial planning in general. A few points here. Nobel Prize winning economist Richard Thaler uses the phrase longevity literacy. And what he means by that is he's underscoring the importance that each of us understand our own life expectancy. Second, a Boston College study finds that many people, actually most people, underestimate, and not only underestimate, but significantly underestimate their own life expectancy. And third, my favorite professor, Dr. Wade Pfau, reminds us that half of us will outlive our life expectancy, and usually by a fair margin. Listed here on the left are several factors that predict or drive life expectancy. And you'll note that if you look through this, a number of these are factors over which we have control. Many of them are lifestyle factors. One of the factors, for example, that we don't control is the fact that women on average live longer than men. Here's a factor where we do have some control. where we live. I'm going to share with you some good news here. The fact that we live in California means that we live in the state that is in the highest quartile for life expectancy. So I'm sharing with you, on average, us California residents here have 5 bonus years of lifespan versus those that live in a lowest quartile state, such as Louisiana or Alabama. That's the good news. All right, let's dive into a couple of examples here on how we can calculate life expectancy. So you see here that first link, the top link, that is the link to the Social Security Actuarial Life Table. The second link there is a calculator. It's called the Lifespan Calculator. And we are big fans of calculators such as this one here. And the reason is, you remember the prior slide where you see all of the factors that go into the mix in predicting life expectancy, many of them over which we have control. The lifespan calculators and calculators like the lifespan calculator take that personal data, that lifestyle information into consideration in giving us a life expectancy. By the way, in one of your handouts, we have both of the links there. So you can have some fun with this after our session. In the meantime, I'm going to be the guinea pig here and take you through 2 scenarios. Oops. This is my life expectancy. So first up here is my life expectancy according to Social Security. Now, Social Security, the table, and by the way, you can find this table on the Social Security website. So you can do this yourself. There's only 2 factors that drive the life expectancy calculation for Social Security, and that is age and sex. So I look 63-year-old male, and it shows I have a life expectancy of 18 years and a few months. So that's kind of sobering, by the way, when you look at your own life expectancy. By the way, I will note, if you go all the way out, down that row, all the way to the last column on the right, you see that figure of 21.29. What that is life expectancy for a 63-year-old woman. So women on average live longer than men. Okay, let's look now at the lifespan calculator and where I come out. So there's 13 different input slides. So asking me a number of different questions. The first slide, and I'm not going to take you through all of my answers, but I'm going to give you a few examples here. Same information that I looked at for Social Security life expectancy, correct? 63-year-old male. The second slide on the right there, you can see I put in my height and weight. So I was connecting some of the dots, thinking maybe if I eat fewer cookies, I might live a little bit longer, but that's for another day. And on the left, this is all of the information, all of the queries that the lifespan calculator extracted from me. So again, back to looking at different factors that predict or drive life expectancy. A number of these I have some control over. Exercise, whether I smoke or not. One of the interesting questions, or a few surprises or ahas for me, was do you wear seatbelts or not? That apparently predicts a longer life expectancy if you do wear a seatbelt. So I went through all of those questions. I got to the last page. I was waiting for some computer drum roll that never came. And you see it on the right there. Age 94. Now again, am I going to live, as somebody said a few minutes ago, the future's uncertain. Am I going to live to 94? Who knows? The point is what the lifespan calculator does is say, for a 63-year-old male who answers the questions like you did, we estimate a life expectancy of age 94. Now, think about that in contrast to Social Security. 13 more years. It's actually almost double, right? It goes 18 years to now I've got 31 more years. How might using a age 94 life expectancy assumption change the way I make financial planning decisions in general? And to our topic today, make claiming decisions around Social Security. You remember Meghan showed those 3 lines? And if I remember right, in one of the examples she showed, age 81 was about the crossover point. If my life expectancy assumption is age 81, I'm more inclined to take an earlier Social Security retirement. If, on the other hand, I'm using a life expectancy estimate of, say, 94, I might come to a different conclusion. Bottom line here for us, we think the life expectancy assumption you use is critical, not only for claiming Social Security retirement benefits, but also for your financial planning overall. And we suggest that you consider using something like the lifespan calculator. So I'm going to pause here. Any questions at this point? That is a great question. Let me repeat it. And then it is, well, let me repeat it first. So paraphrasing, you're asking or suggesting that perhaps the type of investment return you get might influence when you claim Social Security, depending on what your assumption is on your investment return. Is that okay? Meghan, it's a perfect segue. Meghan is going to talk about that in just a few minutes because there's a number of factors that drive that decision making. So I'm going to bring Meghan out here now, and I'm going to leave Meghan with a question too. Is Meghan does 20 or 30 financial plans for our clients a year, goes very deep, comprehensive. I'm going to ask Meghan to answer the question on what we use for our life expectancy assumptions when we do financial planning for clients.
All right. Thank you. We will get to your question, but if I don't answer it, please circle back with me, okay? And for our financial plans, we use age 95. So we think that's a little conservative for most people, right? But I want to make sure that you're not running out of money in your financial plan. Because what if you do live till age 95? Or probably very likely, your expenses are a little bit higher than you projected. And so we need a little bit of cash buffer. So that's how long we run our financial plans. So life expectancy, we've made that point clear. It's very, very important, but don't assume that your life expectancy will be too low because that may sway your decision and not make a clear one, okay? There's lots of other things that we have to consider as well. What's your health like? What's your family longevity? Are you going to live a long time or not? We went over some of those factors. What other assets do you have? Do you have other accounts that you can pull from while you delay Social Security? If you don't, you might have to take Social Security early. Is there an age difference between you and your spouse? I'm going to show an example of that one in a moment, but that may lend itself to maybe a blended strategy. One of you takes it at full retirement age, maybe one delays, a combination strategy. What's the amount of your benefit? If you have a lower benefit, if you didn't contribute a lot to Social Security over your working career, you might want to take it earlier, especially if you have a spouse who has a higher benefit. You might want to take your smaller benefit earlier, just provide some extra cash for the family. Your investment risk tolerance. I'm going to pause there and I'm going to come back to that in a moment. And that gets to your question. Your retirement age. You know, if you retire at 60, you might need to start pulling money soon. But if you're not going to retire until 70, you might want to just leave it and let it grow. Why not? And of course, if you have pensions or other sources of retirement income, that could sway your decision. So lots of different factors here. I'm going to go back to example one, but now knowing some of these factors, I'm going to point to different scenarios where you could be better off taking it in different strategies. So for example, in the red box, if you have a shortened lifespan, a pre-existing medical condition, or you're in poor health, might be best for you to take Social Security before full retirement age, right? Because if you're only going to live till 75 or 80, you'll get the most from Social Security if you start it right away. If there's an age gap between spouses, as I mentioned, one of you or both of you could take it around full retirement age. If you have an early retirement, you may want to take it around full retirement age. Or if you have an investment risk tolerance. And this is going to touch on your question, but I think this is a really important thing that I want you guys to take home with you today. If you're an aggressive investor, meaning you have lots of stocks, very little or no bonds or fixed income in your accounts. Think about your 401ks or retirement accounts. Okay, if you're aggressive, you should over a long-term average expect maybe 8, 9, 10% returns over a 10-year period or so. Okay. If that's the case, then why not take Social Security, which grows at 8% per year, and let your 9 or 10% investment account grow? Take Social Security now, don't touch your investment account that's earning more money, right? On the flip side, which I think will be more of you, in the green box, you'll see low investment risk tolerance. I would say most of my clients who are at retirement or approaching retirement are in more of a moderate portfolio, which we would say is about 65% stocks, maybe 35% bonds or fixed income. That type of account might only earn 5 or 6% a year. Less risk, smoother ride along the way for you, but less return potential. So if my moderate portfolio is only earning 5 or 6%, I'm probably going to pull out of that and let my Social Security grow at 8%. And the Social Security is, we use air quotes here, make sure you see those, guaranteed 8% per year. I use the quotes because nothing in life is guaranteed, but at least that's the way it is right now. Okay, so your investment risk tolerance changes maybe when you should take it. Again, other assets to draw from. If you have pensions, then you can always wait to take Social Security. And of course, if you have a long life expectancy, if you're going to live into your 90s, delay that Social Security if you can. All right, let's take a real life case study. These are real clients of mine. There's 2 graphs here that I want to go over with you and show you the impact of taking Social Security at different ages. Now, the primary difference here that has not been on the previous slides is all the previous slides we've been looking at the Social Security decision in isolation. Remember? This is in someone's financial plan, the context of their financial plan, meaning we have taxes at play, we have retirement accounts there, we have other things going on. And that really heightens the impact of when you make this decision. So the graph on the left, the horizontal axis is time, far left is 2025, that's today. Far right is the client's age 95, so this is the rest of their life. The blue bars indicate their portfolio. Think of portfolio as like all your money, cash, retirement accounts, does not include real estate, just your money. So right now, today, these clients have about $2 million in the bank, growing, and then it kind of declines. But at age 95, they still have about $2 million in the bank. And that is if they delayed their Social Security to age 70. I'm using real life Social Security numbers for these people. Okay. Now, the graph on the other side shows if they took it at full retirement age. That's the only variable that I've changed. Okay. So instead of having $2 million at the end of life, they have $68,000. That's a $2 million swing. $2 million swing. And again, the slides before are looking at Social Security in isolation. Here we're looking at things like if they take Social Security early or delay, that changes their taxes. They're going to have to take money out of other accounts. It changes so many other things, which is why, again, it's so important for you to have a financial plan and to make your decision in the context of your financial plan. But even without that, I want you to see that the impact here is a $2 million swing from taking it at 70 versus 67. Now, an even bigger swing. The graph here on the left is if you delayed. That's what we looked at previously, same graph. The graph on the right is if you took it at 62, if you took it early. So instead of ending up with $2 million at age 95, now you ran out of money. You're negative $2 million at age 95. So now you're running out of money in your 80s. Major difference. That's a $4 million swing in the other direction. Okay, so you get it. It's really important. Hopefully I've made that one clear. All right, let's talk about this other effect that can be scary for some people, but it's a financial planner's dream, we'll call it. So what's in front of you is a real life client of mine, 2 spouses, and their tax report. Okay, we won't get in the weeds on what the report's saying, but what I want to draw your attention to is this box, this red box, and the years and what's happening here. Okay? The client retires, let's say around 2029, and their income on paper to the IRS looks like it goes down to 0. They don't have any more income. They're retired. Maybe they have a little bit of investment income, but by and large, they're paying 0 federal taxes. And if you look on the far right at their effective tax rate, it's 1%, 2%, all the way down from 26%. Okay. Now, the reason I say this is sometimes scary for people is if this was you and I said, look, you have no income and you're paying no taxes because you don't have any money. People are like, whoa, what's going on there? I need money to live on. Of course you do. However, what this allows us to do is it creates an opportunity for us to have different tax strategies, to be clever about where we pull money from to keep you in this low tax bracket. What appears that way on your tax return. Okay? This isn't something illegal or a loophole. I feel like I'm making it sound mysterious. It's just good tax planning. So there's an opportunity to withdraw money from your IRAs or 401ks with no or very little taxes. And again, this is if you delayed Social Security. If you took it earlier, then you're going to have that taxable income and the window of opportunity kind of goes away. This also creates an opportunity to allow Social Security benefits to grow at that 8% per year while you take retirement assets out of your 401k that are growing at about 4 to 6% per year, which is what I mentioned on the previous slide. So just another way of me saying this is an opportunity. If you delay, there's a lot of cool tax stuff that we can do as well. Okay, let's move on to a different example. You'll see at the bottom 2 spouses again. This time I just threw in an age gap. Client 1 is age 62, client 2 is age 55. So if you and your spouse have a little bit of an age gap, but you still have similar benefits, this is what the graph will look like. Same lines, kind of how much are you accumulating from Social Security by taking it at different ages. But you'll notice here I threw in a 4th line. It's the blue one. And it's a combined strategy. If one spouse took it at full retirement age, but one spouse delayed till 70. Ultimately, that is the line that wins in this scenario, kind of out there. Little bit hard to see. So let me illustrate in a different way. All right, so here, let's look at the numbers here. You have the year and then the ages of the spouse, and I've highlighted when they take Social Security. Let's say that spouse 1 is the older spouse and they take it at full retirement age, 67. Spouse 2 is the younger spouse and they wait till 70 to claim benefits. And you see their Social Security income. So spouse 1 starts at 67 and their benefits $36,000 a year. Spouse 2 delays and it's $44,000 down there at age 70. So why would this be helpful? Well, in my experience as a planner, in your 60s, it is a very expensive time. And I'll give you some examples. You retire and you say, I have all this time, I'm ready, I want to travel, I want to do all the things that I couldn't do when I was working. and that travel budget goes up and some other discretionary spending goes up, some hobbies, some entertainment, right? And usually that kind of trails off maybe in your late 70s or early 80s, but those 60s and early 70s, lots to do, lots going on, lots of expenses. If you have kids, very expensive. 1 or 2 kids. They might be in college or finishing college. We all know how expensive that is. Then they graduate college, they get married. Maybe you want to help with a wedding or help them with a house, buying a house. Very expensive. If you retired before age 65 and you are not eligible for Medicare yet, then you have to go on private medical insurance. And for a lot of us, that can be very expensive. And lastly, a very common thing I see is, again, you retire, you have some time, and you're like, oh, I've wanted to redo the kitchen for so long. Let's do it. Maybe some home projects or the backyard or something. Okay. So the point is that this can be an expensive time of life, and having a little bit of extra cash from one spouse taking it at full retirement age to lighten the load of withdrawals on your other investment portfolio can be very helpful. But spouse 2, who's younger, probably going to live longer or outlive spouse 1. So by letting their own benefit delay till 70, they're providing themselves a greater survivor benefit. Okay. So this is a combination strategy, more cash flow in expensive years, higher survivor benefit for the likely survivor. Okay, I'll just pause here really quick. I'm going to switch gears. I'm done with claiming strategies. So if you've already claimed your benefits and, she's done with that, I'm going to get into some what you need to know, or some things that I find most people don't know about Social Security. So before I move on, is there any questions or clarification that anybody needs? Did I answer your question? Perfect.
I get disability. Is there a choice? So I get SSDI. My family has a trust for me set up. I just lost my folks in the last year, and that's why I'm here today with that burning question. The internet tells me, no, you don't have a choice. So maybe you can shed a little light on that one.
A choice. Can you clarify?
A choice, a when choice.
Oh,
so
when.
SSDI is typically converted. I rely on the money because I have a trust set up to meet my needs beyond the SSDI once they're exhausted, which is earlier in the month as time goes on. And so that's a really burning question. What brought me here today? Is there any choice if you're disabled at 62?
It's a great question, and I'm so glad you came today. I'm not an expert in disability Social Security benefits. My understanding is that when you turn full retirement age, you'll then switch to your retirement benefit from your disability benefit. But I'm not an expert in that area, and I would call, unfortunately, Social Security and ask. Sorry. Okay, good. Okay, good. Hopefully there's something here for you. All right, excellent. Well, let's move on. Okay, so these are just some did you knows. Okay, I'm going to walk through a couple different slides here. So the first one is about the Bipartisan Act of 2015. I don't know if anyone's heard of file and suspend. It was a strategy. People love doing this, and the IRS got rid of it. They said no more of it, and they replaced it with deemed filing. So file and suspend was basically, if you look at the table here, if your benefit, if your spouse's benefit was $3,000, you could take your spousal benefit half, $1,500 at age 62, and let your own benefit delay until you turn 70 and then switch. No longer. Can't do that. Okay, they took it away. It was kind of a loophole and people were abusing it. So that's gone. Now, if you call Social Security and you file for benefits, they will just send you either your spousal benefit or your own benefit, whichever is greater. It's called deemed filing. There's no option. You just get the greater of the two. This is a real life case study and one of my favorites. I love finding money for clients. So I had a couple come to me in 2019 and we did a financial plan. And the man was 62 years old and he had a 10-year-old child. Okay, so he had a minor child. If you are over the age of 62 and you have a minor child, you are owed Social Security benefits for your child. Most people don't know that. So he filed and he got $19,000 a year. It grew a little bit every year. And when the child turned 18, those benefits were over. But over that period of time, he got almost $200,000 from Social Security that he would have had no idea belonged to him unless we did this financial plan together. So if you have a minor child and you're over age 62, I would give Social Security a call and claim those benefits. Another thing that I often hear from clients is, my Social Security check goes down, or I thought my Social Security grew by inflation, but it seems to be stagnant or going down. Well, it's not your Social Security benefit. It's your Medicare premium. So over on the right side of the page, I've put for you from 2003 to 2022, Social Security benefit increases year by year. How much did benefits go up? So over that period, benefits on average went up 2.5% per year. Now, Medicare premiums in the column next to it over that same period have gone up on average 6.1%. So Medicare premiums are growing much faster than your Social Security benefit is. And since your Medicare premiums are taken out of your Social Security check, it feels like when Social Security arrives in your bank account, like I'm getting less or I'm getting the same amount and it's not growing. It's not your Social Security, it's your Medicare premium. This is really exciting and it's brand new, hot off the press here, okay? Some of you may be or were subject to what's called the windfall elimination provision or the government pension offset. Fancy words, I put the definitions there if you want to read them. Basically, if you are covered by a government pension, then you likely receive much less from Social Security because you get that government pension. Well, on January 5th of 2025, just a few months ago, the Social Security Fairness Act was signed into law, which ended the windfall elimination provision and the government pension offset. People that were previously affected by these provisions received a one-time retroactive payment from Social Security in March of 2025 to cover the increase from January of 2024. So let me just, in English, tell you, one of my clients, I love this woman. She's in her late 80s. And she called me and she said, Megan, I got $22,000 from Social Security in my bank account yesterday. What is that? I said, well, that's weird. Let's look at it. So we dug into it. She was on one of these pensions in Marin County. And so she got only a couple $100s a month from Social Security because she had this other pension. Okay. Because this was signed into law, for all of 2024, Social Security sent her the $22,000 that she was owed for 2024. And going forward, instead of a couple $100s a month, she gets a couple $1,000s a month from Social Security. So this is a big deal. If you were covered by a pension and you got little from Social Security, actually President Trump helped sign this one into act. So, which Matt will talk about in a moment, but this makes a big difference. Okay, will your Social Security benefits be reduced if you take them while you're working? Another common question that I get. So the answer is maybe. If you're below full retirement age, so below age 67 or whenever that is for you, and you're still working and you start your Social Security, there will be a $1 benefit reduction for every $2 earned from your job above this limit. And for this year, it's about $23,000. So if you're making more than $23,000 a year from work, I'd probably recommend that you don't start your Social Security just because it will be reduced. We don't want to reduce our Social Security. If you are full retirement age, the year you turn full retirement age, for every $1 of Social Security benefit, for $1 of Social Security benefit reduction for every $3 earned above the limit of $62,000. If you're over full retirement age and you're still working, so if you're 68, 69, 70, and you're still working and you start Social Security, there's no reduction. Okay. So I would just be cautious if you're working and you start Social Security at or below full retirement age. You have a question?
Okay, I took Social Security at 62 and I started working again at 65. Could I stop, taking Social Security?
It's a great question. Everybody heard the question. You can't stop taking Social Security. Once you start it, it's started. Talk to me after. I think you might be okay. But no, you cannot stop Social Security and then start it again later. Do you have another question? Yeah.
I was a teacher in the 70s, and 80s. And I get a pension that's really, started out at 500 a month and is only up to 650 a month. And they called it double dipping back then. But I worked in the private sector for more years than I did Social Security or as a teacher. And yet my Social Security was only about 600 a month. So the two combined were about 1,200 a month for all these years. Fortunately, I didn't have to worry too much about that because we had income other places. But that's certainly, I worked for most of my life and those two benefits didn't add up to much. I did get a check for like $7,000 and my Social Security went up by 150 a month. He gets a lot more than.
It sounds like you can, but let's talk after so I can hear more about your situation.
Okay.
Yeah.
Yeah, they call that double dipping, and it was really horrible.
Yes.
Thank you.
You're welcome. That's a good point. So Social Security takes your top 30 years of earning history, and that's how they calculate what your benefit will be. So it's how much you paid into the system over your top 30 years of earnings history. Yes.
How much do you actually drawing Social Security? Can you, is there a limit?
Oh, for,
If you're working or
yeah,
you
if
decide you want to work and you're 70 and you're also drawing Social Security, is there a limit to the amount of income you can make annually?
no. So the question was, can I make an unlimited amount of money over age 70 and collect Social Security? Yes, there's no limit. As long as you're over full retirement age, there's no reduction in benefits. You can make as much as you want. All right, well, let's move forward here. I have just a couple more. So does that statement look familiar to anybody? Has anybody ever seen that? Yeah, okay, I'm seeing some nodding heads. Perfect. All right, so Social Security used to mail this out to us, but they stopped because paper is expensive, so now you have to go online to get it. But what they are doing here is they are estimating. They're telling you at the top of the page in the right, if you started Social Security at different ages, what your benefit would look like, right? So you might have read this statement and said, oh, for this example, if I took at full retirement age, it'd be $1,900. If I waited till 70, it's about $2,400. Okay, all that's great. I want to point you to what's in the little footnotes that probably most people don't read. And that is about the assumptions that Social Security is making to calculate those numbers, okay? So, for example, Social Security, they use your tax returns. That's how they know how much income you have, right? So Social Security is looking at your tax return from 2 years ago, and they are projecting that you're going to make that amount of money until that claiming age. So if you look at what will my benefit be at age 70, Social Security is saying she's going to make what she made 2 years ago, and she's going to keep working at that earnings amount until she's 70. Most people aren't doing that. That's not a correct assumption, but it's no fault of Social Security, right? They don't know what your plans are. That's where, again, the financial plan is really helpful. Like we have software, we know, okay, you plan to retire at 63, no more work, or you plan to slow down at your job and maybe make less the last couple years, and then delay your benefit till 70. So we can specifically put in your future income and project a very accurate benefit because we know what you're going to do, whereas Social Security doesn't know, so they have to make some assumptions. So just know if you get this or you see this, it's helpful, might not be 100% accurate. Are Social Security benefits taxed? Another very common question that I get. The short answer is yes. At a federal level, usually they are taxed. Okay? I put the different brackets up here. If you're a single filer and your income's between 25,000 and 34,000, 50% of your Social Security benefit is taxed. Now, hold on. Sometimes people see that and think 50% tax rate. No, no, no. Just 50% of your benefit is taxable. And then if you're single and your income's over $34,000, 85% of your benefit is taxable. I also put the same brackets down there for married filing jointly, so you can see where you fall there. So most people pay tax on Social Security because their income is usually above $25,000 or $32,000. Okay? Just depends if it's 50% taxable or 85%. Now, California usually isn't very nice to us when it comes to taxes, but here they are. They do not tax your Social Security benefits. Only the states in the box on the right tax your Social Security. California is not on that list. So thank you, California, for that. All right, here's just a quick example to kind of show you how the taxation works or how much of your benefit would be taxable. So the first box on the left gives you an example of potential retirement income. Let's say this couple, they have $45,000 in IRA distributions or 401k distributions. They have $100,000 in pension income. They get $60,000 from Social Security benefits, and they have about $5,000 of investment income. So per year, they have $210,000. Now, they're married filing jointly. Their income is more than $44,000 per year, so 85% of their Social Security will be taxable. They get $60,000 from Social Security, so $51,000 of that is taxable at whatever their income rates are. That makes sense? Helpful with an example. Okay. All right, so you can see there's a lot going on here. There's a lot of considerations for you to have. But the piece that I really want to drive home for everybody is that Social Security and all your financial decisions are really one piece of the puzzle. You really have to look at how all these decisions interact with one another and what's the best decision for you and your family. Hopefully that was helpful. I'm going to turn it over to Matt, and he's going to talk about probably what you came here for, the future viability of Social Security and what we can expect going forward. Thank you.
So a few comments before we hit the home stretch here. One is, if you have questions, of course, we're going to have ample time to answer questions at the end of our session today. If you have questions and you don't get a chance to ask them, do feel free to email me and just mention Vivillon. I'm happy to answer. To the gentleman that had the question regarding the transition from disability to retirement, Meghan's answer is a good one, an accurate one. And some of these questions are quite nuanced. If you send to me, my email address is there, your question, and just mention Vivillon. We have, beyond Meghan's expertise, there is an expert we can tap who's probably in the top 10 in knowledge on Social Security nationwide. So we can tap her. So again, feel free to ask those questions. I want to make the comment too that California is getting some wonderful PR today. So one is, we know now that we're going to live 5 years longer because we live in California. And two, we don't pay taxes on Social Security in California. So a couple of reasons to love California. Okay, earlier, Meghan talked about assumptions. And again, assumptions are so important regarding your financial plan overall and regarding your Social Security claiming in particular. We talked about life expectancy. Meghan also alluded to the present bias. So think about your own assumptions. If you haven't claimed Social Security retirement benefits yet, maybe explore what your assumptions are around the long-term viability of Social Security. we're going to talk about that in a little bit more depth here in just a few minutes. We're going to share what our belief is on the future of Social Security, and also how we think you should frame your Social Security claiming decision going forward. So let's first talk, before we talk about the financial viability of Social Security, let's talk about Social Security in the news lately. Have any of you heard any or read anything about Social Security recently? Okay, a few of you have. So of course, what I'm alluding to is the fact that the White House, and in particular Doge and Elon Musk, have, let's call it, targeted, focused on a number of government agencies, and one of them is Social Security. So high level, here's what we believe, is everything that we read in the press and the pronouncements and announcements that come out of the White House, what we believe is this, is Social Security benefits, but with all of this chaos and noise that's going on, Social Security benefits will not be compromised, period. What we do believe is that the Social Security Administration service level will be compromised. So let's talk about a few questions and answers. So the first one is, are Social Security offices really closing? The short answer is no. There was a press release that Social Security put out at the end of March that said we have not closed any offices. Now, more recently, Social Security has shared that they have closed what they call hearing offices. And these are small offices where they have hearings with Social Security claimants, Social Security beneficiaries. And this is largely due to the fact that much of the hearing process can be done virtually, remotely now. My understanding here is of late that one Social Security office has been closed, but we don't expect to see a lot of Social Security office closures going forward. Second question, are Social Security call times long now? Yes. Unfortunately, you think about this, it's like a perfect storm. So there's all this focus from Elon Musk, Doge, the White House, and the press on Social Security. So that creates, one, a lot of confusion, and two, a lot of concern. So what happens is a lot more of us call Social Security. We want answers to questions we have. We also want to feel better. We want security, to know that Social Security is going to be here. What's also happened with this chaos is there's been a lot of starts and stops for Social Security. One article we read recently said that so many of Social Security staff have not been trained on the changes that have been made. So calling Social Security, you're going to be on hold a lot longer, and there's a higher probability that the person on the other end might not know the answer given the chaos. A few things we can tell you about call times is this is perhaps a small consolation, but there are better times to call Social Security if you need to call. One is Mondays and Tuesdays, don't call on Mondays and Tuesdays. Wednesday, Thursday, Friday, call in the morning, 8 to 10 o'clock in the morning, local time. Those are ideal times to call. And also, if you have the flexibility, call in the second half of a given month, not in the beginning of a month. We saw an article by Kiplinger's just a few days ago. It said the average call wait time for Social Security in the month of March was 1 hour and 39 minutes. So know that. Expect to wait longer. If you need to get answers from Social Security, start early, meaning don't delay, don't procrastinate. Get it done. The earlier, the better. And whenever possible, go online. It's usually the best, not for everything, but it's usually the best approach. Are Social Security payments being made to dead people? Short answer is no. Yeah, maybe a few. But again, this was in one article we saw, pardon the pun, but they said this point refuses to die. It is still out there, and it's out there as if it were truth, and it's not. Social Security ID verification. Yes, question. So again, whenever possible, go online to see if you can take care of your business that way. That's ideal. And if you do need to talk to someone at Social Security, I do believe what you said is correct, is that you do need to make an appointment rather than just drop in. Yes.
I had heard any kind of updates, any kind of Social Security updates that you wanted to find out about, you had to go and sign up for X to get those updates, which is Twitter, now X, that you would get your Social Security updates via X. I saw that on TV the other day.
I do not know that. I can't say if that's true or not. I've not heard that. And again, if you email that to me or see me after, I'm happy to follow up on that. That's curious. The second to last point here is ID verification. There is some fraud, and again, it is not as widespread. It's less than 1% fraud at Social Security research finds, is that for certain things, and it's an initial claiming, if you're claiming benefits initially, or if you're changing your account information, in other words, changing the bank at which you have your Social Security benefits automatically deposited. You need to now, that used to be able to be done over the phone with some questions and answers. Now it needs to be verified. You can do that online if you're tech savvy, or otherwise you need to go in person. Last point, this does not keep me up at night, is some people are concerned that is the present administration going to take away Social Security? I do not believe that's the case. And we'll talk about this a little bit more in the next few slides, but previously in past years, President Trump has supported Social Security. He supported it during the campaign, and in two ways, meaningful ways, I think he has supported Social Security. One is he has frequently suggested that income taxes on Social Security be done away with, which of course would have the effect of increasing benefits to retirees. The second one is Meghan talked earlier about the Social Security Fairness Act, which was passed. President Trump supported that. So again, I think it's really about service will be compromised, but not benefits. All right, let's talk about, thank you.
Yeah, one question. If I deposit in one direct deposit from Social Security in one bank, and I want to change the bank, I think the bank can do that. I don't need to do through Social Security. Is that right? Or
that I don't know, and I'm happy to follow up with you on that. What I have heard.
Past time was possible, you know,
okay.
to do that.
What I don't know is the change with respect to Social Security now. That's actually one of the transactions where Social Security has said, if you're changing the bank at which you make your direct deposit, you need to now verify identity. So I don't know if, to your point, if the bank does it, if that avoids you having to go through that step or not. But I'm happy to follow up on that for you. Thank you for bringing that up. So let's talk about the future financial viability of Social Security. Social Security is described as a pay-as-you-go system. And what that means is that current payroll taxes from current employees and their employers fund current benefits to Social Security beneficiaries, disability, survivor benefits, and retirement benefits. We talked about Social Security turning 90 this year. this pay-as-you-go model has worked so well for 80 some odd years until now it's not working so well. And the key reason is demographics. 1960, there were more than 5 workers for every retiree. Today, the math is more like 2.7 workers for every retiree. And that worker to retiree ratio is going to continue to diminish. Why is that the case? Longer life expectancies, lower birth rates, and the baby boom generation. Some of you are in that cohort. I'm in that cohort. We're either retired or retiring. So the math just doesn't work like it used to. This graph here shows, you can see the lines above the vertical 0 line. For many years, Social Security ran at a surplus year to year. And that was because, again, the math on worker to retiree ratio. Since 2021, the system has actually run at a deficit. My understanding is this past year, the deficit was about $41 billion, which for Social Security is actually a fairly small number. It's huge to all of us, of course. So where does that $41 billion come from? Well, the good news is for all those years, there was a surplus. That surplus was put into what was called the Social Security Trust Fund. There's actually more than one trust fund, but whenever these conversations are had, when you read about it in the press, it's typically called the Social Security Trust Fund. So the trust fund has accumulated all this surplus money, and there's currently about 2.7 trillion, not billion, trillion dollars in the trust fund. So the trust fund makes up the deficit. That's the good news. The bad news is because of the money in, money out, the declining workers for retirees, that deficit is going to continue to grow until about, depending on what study you look at, 2034, 2035, 9 to 10 years from now, the trust fund will be depleted.
Dipped into the fund and taken the money from Social Security for other things, which has, I don't know if you'd call it illegal, but it shouldn't be that way.
That gets complex in that a lot of the surplus is invested in government IOUs. So treasury notes, treasury bonds, et cetera, et cetera. So technically, we're putting government IOUs in there. But if you take a step back, treasuries, US government bonds are a pretty good way to invest. So there's more to that. And thanks for bringing that question up. It's a little deeper than I can go right now, but thank you for bringing that point up. All right, so question. Thank you for that question. What happens when the trust fund is depleted? And I'll connect the dots on your question. I guess you're asking, is Social Security broke? Is it game over? No. The good news is this, is remember the pay-as-you-go? There's going to continue to be workers paying payroll taxes. Their employers are going to be paying payroll taxes. And depending on the study you look at, anywhere from 79 cents on the dollar to 83 cents on the dollar. So if nothing was done between now and 2034, 2035 and beyond, we would still be able to fund benefits for decades, actually 75 years, at the rate of 80 cents on the dollar. So that's the good news, bad news. If you're a current retiree or you're planning for retirement, it's like, I don't want to get 80% of what I thought I was going to get. So what has to happen going forward? And what do we think will happen going forward? Former Fed Chairman Alan Greenspan once said at a conference, and this is about 15 years ago, he was asked, how do we handle the Social Security looming shortfall? And he said, it's easy. He said, we could do that in 15 minutes, and that includes 10 minutes of small talk. And he's right. It is a really simple math solution to the Social Security problem. It's money in or money out. So we either have to increase revenue, reduce benefits, or some combination of those. Quickly on the right, you see a few examples. We can increase payroll taxes to both workers and employers. We can remove the cap if you're lucky enough to make 176,000 plus a year this year. You stop paying the 6.2% into Social Security once you hit that point. Remove that cap, that increases taxes. We can reduce benefits. One way is to put a cap on the COLA, the cost of living increase that happens each year. Meghan talked about that. Or we can push back the full retirement age. Remember that one slide Meghan showed where if you were born before 1942, your full retirement age was 65, and it is moved over time? That was done back in the 1980s to reform Social Security and help put it on stronger financial footing years ago. We can do that again going forward, or some combination of those two. But again, it's a money in, money out scenario or dilemma. So bottom line, economically, really simple to solve the Social Security shortfall. The challenge is it's done in the political arena. So that political cartoon kind of sums it up. Is on the left, Democrats generally will say, let's reform Social Security, but we can't cut benefits. Republicans on the right will say, let's reform Social Security, but we can't raise taxes. Harkening back to the 1980s, there was a bipartisan agreement that got us to a good place, and hopefully that will happen going forward. All right, the future of Social Security. Why do we feel that Social Security will be here in the short term and in the long term? And why do we build our financial planning assumptions where we assume Social Security will be here for 10, 20, 30 years? Here's a few reasons why. First of all, we talked about Social Security's impact at the outset. Remember, the 97% of us are either getting benefits or will get benefits. Remember that 170 million Americans are currently funding Social Security. That something like 70 million Americans are collecting benefits. That's really powerful. Those numbers are powerful. And those beneficiaries, we all vote. That's powerful. Second, Social Security and poverty. Independent research finds that Social Security keeps about 22 Americans out of poverty. In other words, Social Security benefits are the difference between 22 million Americans living in poverty and not living in poverty. And of those, 16.3 million are adults age 65 and older. If Social Security was gone, how are we going to take care of those people? Third, Social Security is immensely popular. 86% of Republicans surveyed last year, 90% of Democrats support Social Security and want reform to fix the system now. How often do we get those kind of numbers from both sides of the aisle? Which leads to the fourth bullet point. Politicians know this. They know how popular Social Security is. That's why it's called the political third rail of politics. That means if you're a politician and you in any way harm Social Security, you are committing political suicide. And finally, I mentioned it earlier, back during the 1980s, during the Reagan administration, we had a Democratic Congress. They came together in a bipartisan way. And the changes they made to Social Security were, one is they raised taxes. Social Security used to be tax-free. Now there's taxes on Social Security. So that's one way they raised revenue. The other thing they did was reduce benefits. And they did that by pushing out the full retirement age, but they were really smart. They didn't do it all at once. They did it over 33 years. And we were at a conference recently where former chief economist for Social Security spoke. This is about a month ago. And he said, the wisdom in the leadership at Social Security and in Washington, the politicians understand that when it comes to fixing Social Security, you can raise taxes quickly, but any reductions to benefits must be done very slowly and over a very extended period of time. And that's only humane. If you're retired right now and getting Social Security benefits, you depend on those. If you're not retired, but you're planning for Social Security in the future, again, you're going to depend on the expectations and estimates that you have. So any reduction in benefits, we are confident will be done as it was done in the 1980s over many decades. All right, lastly, last slide before our summary is this, Social Security. So what does it mean to you when you think about the long-term viability of Social Security? Here's what we recommend is tune out the news, tune out the noise, and focus on your own circumstances. Meghan shared how you need to make Social Security retirement decisions in the context of your overall financial plan. Look at your own assumptions around life expectancy and all of those factors that go in. But do not make your Social Security decisions based on fear or concerns, news and noise about the future of Social Security. Our assumption is that Social Security will be here in the short term and will endure for generations to come. So we have a summary slide, but we only have about 15 minutes left, and we want to make sure we get as many questions as we can. So let's open it to questions now. All right, just a few points. I'll go through these quickly, and thank you for that. We talked about the impact of Social Security, huge impact on the US economy and society, and of course, a critical benefit for all of us individually. Social Security terms, Meghan went through a number of terms, full retirement age, on and on and on. The more you know about Social Security, the better your decision-making will be, we feel. Meghan talked about that annual statement, which now you need to go online to look at it. We encourage you, read that start to finish. And if you stay awake, you'll know more than 98% of Americans about Social Security. We saw examples from Meghan. When you claim benefits, how you claim benefits can really have hundreds of thousands of dollars of difference. Look at Social Security in the context of your own financial plan. All of your assumptions, challenge your assumptions. Look at your assumptions in your financial planning. Life expectancy is really an important assumption. Many factors go into the mix besides life expectancy. Health, when you want to retire, other assets, et cetera. COLA, the cost of living, it's a wonderful benefit that Social Security retirement provides. Medicare sometimes erases all or most of that year to year. There's other features in Social Security retirement, spousal benefits, survivor benefits. There's some excellent strategies that Meghan talked about that allows you to maximize these. Retirement benefits can trigger earnings offsets and taxes. Again, the more you know, the better you're able to decide. Social Security offers a number of opportunities and traps. Again, the more you know, the better. We talked about the future of Social Security. We feel strongly it will be here for the future. It is an American icon, and it's just well, it will be here in our opinion. And finally, make your Social Security decisions based on your own circumstances, not looking outward on Social Security and its future or the current headlines that you might read. Well, on behalf of Megan, we thank you all for being here, and thanks for an engaging conversation. We appreciate all the questions. And of course, our friends at Vivalon, Paige, Juliet, Yvonne, and Amy, and thank you all. Thank you.